So today we're going to cover chapter 6, which deals with business income. Now, just sort of as a review of what we sort of have covered so far, if you remember from chapter 3, we covered employment income. So three, chapter 3, we basically covered employment income. What we're going to do today is chapter 6, which is business income. And next week, we're going to do chapter 7, which is property income. And so once again, for those of you that are just joining us, the midterm is in 2 weeks' time. We're going to cover chapter 6 today, chapter 7 next week, and then the week after that, which is 2 weeks tonight, is our second midterm. And I'll provide you more details about the midterm over the next week, and I'll answer any questions about that next Tuesday. Chapter 8, after midterm number 2, is capital gains. And the reason why we have these separate chapters is that there are different rules that deal with calculating the income from employment versus the rules for calculating income from a business versus rules for property income versus capital gains and capital losses. So today we're going to focus on business income. And at the top here, business income basically requires these sort of 3 criteria in order for it to be considered business income. So when it comes to business income, bear with me for 1 second. Just noticed a typo here. When it comes to business income, the courts have basically said that these 3 criteria must be in existence in order for it to be characterized as business income. So the first one is there has to be sufficient amount of time, attention, and labor devoted to an activity. What basically that means is that it must not be a passive activity. And if it is a passive activity, that's sort of where it might be characterized as property income, where little to no activity is required to earn that income. So business income requires a sufficient amount of time, attention, and labor devoted to that specific business activity. The activity must be in the pursuit of profit. So it basically means that profits are sort of attainable, and this is not a hobby. So a hobby would be a situation where you're doing something, some sort of activity. You may be dedicating quite a bit of time, attention, and labor, but you're not basically in pursuit of a profit. You're doing it for sort of the enjoyment of the activity. With a business income, there has to be sort of that pursuit of profit. Profits are attainable. You may not have profits every year, but based on sort of what you're doing, profits are attainable based on the activity that you are doing. And then the third criteria is that you're incurring potential or actual liabilities to other persons. So for example, if you're carrying on a business, you probably will be owing goods or services to your customers. So that incurring of liabilities or potential liabilities is another criteria for business income. So that's sort of what the courts have said needs to be in place in order for the income to be characterized as business income. And one of the reasons why is that business income usually has a lot more allowable deductions and expenses versus other types of income. If you remember from chapter 3, when we talked about net employment income, there was very few expenses that an employee could deduct. But with business income, there's a lot more of expenses that are deductible for income tax purposes. Now, why does correct classification matter? Once again, business income, usually there's sort of more deductions. But the reason that characterization is important is if a taxpayer, and I use TP here as an abbreviation, is experiencing a loss, the taxpayer will likely want to have it all be deductible. So if it's treated as business loss, it would be 100% deductible against any type of income. If the taxpayer has a gain or profit, they may want to treat it as a capital gain because only 50% is taxable. And the CRA would probably argue the opposite. So that's sort of why these rules are important, because we want to make sure that whenever there's any source of income, whether it be a gain or loss, that it's characterized properly. One of sort of the big areas where there's a lot of sort of disputes with taxpayers and the CRA is on the sale of real estate. Usually real estate will be sold at a gain. Obviously, sometimes it can be sold at a loss, but usually with real estate, the holder of the real estate will wait until there's a gain before they sell it. So if it's sold at a gain, the taxpayer obviously will basically argue this is a capital gain, so only 50% taxable. But then the CRA sort of may argue that it is business income if the taxpayer has a large number of similar transactions. And this sort of had happened a lot with CRA audits where a taxpayer may have sold a number of real estate investments and they calculated the amount as a capital gain, only being 50% taxable. But then the CRA argues, well, you're devoting a lot of time, attention, and energy to this sale of property, and you have many of them over a number of years. So the CRA may argue that it's business income and not a capital gain. And so that's sort of where a lot of the disputes happen, is with the classification of income between the CRA and taxpayers. And so once again, what we're going to focus on today then is business income. There's another term that's talked about in the textbook, which is this term adventure or concern in the nature of trade. So adventure or concern in the nature of trade. Basically, what that is a one-time transaction where the taxpayer acted in a business-like manner. And because of that, the CRA is going to treat it as business income. So remember we set up here that in this example, if there's a number of similar transactions, then that would be argument in favor to the CRA that it's business income, kind of like you're buying and selling inventory. You're buying and selling a bunch of real estate all the time. So that would be a sign that it's business income. But if it's just sort of a one-time transaction, if the taxpayer acted in a business-like manner, sort of like as a trader or dealer in whatever item was being sold, then the CRA could also argue that it is treated as business income as well and not a capital gain. Sort of a common example is if a taxpayer buys shares of a startup company, usually when you buy shares and you sell shares, the gain or loss is treated as a capital gain or capital loss. And that's because the expectation is that you're buying the shares in anticipation that there might be dividend income. And so it's treated as a capital asset. But if you buy shares of a startup company and there's no history or expectation of dividends because it's a startup, they're not going to be making money for at least a few years. So there's no expectation that any dividends will be paid. And then you sell the shares maybe a week later for profit. That could be argued as an adventure or concern in the nature of trade. It's a one-time transaction, not multiple times, but the actions of the taxpayer were like that of maybe a stock trader, someone who does day trading. They sort of see this opportunity to buy these shares. They're not buying it for the long term. They're not buying it for dividends. They know that the share price might go up really quickly. They buy it, sell it within a week. Even though it's a one-time transaction, there could be an argument by the CRA that this is an adventure or concern in the nature of trade. Any questions about what we've discussed so far? One of the main things we're going to see in this chapter is that when we're talking about business income for tax purposes, is not always the same as our accounting income. And I want to sort of stress that even though accounting rules sometimes apply for tax purposes as well. They don't always apply to tax purposes. Sometimes there are different rules for tax purposes versus the accounting rules. One of the court cases that's talked about in your textbook on page 329 went all the way up to the Supreme Court, and it dealt with IKEA Canada. And so when a case goes to the Supreme Court, basically that's sort of the highest level. And whatever the Supreme Court decides will basically be sort of the last decision for that particular matter. So let's just sort of talk about this. And this sort of illustrates how there are rules for accounting that may not necessarily apply for tax purposes. So we don't have all the facts, but what we do know based on what was talked about in the textbook was that IKEA entered into a long-term lease. So they're leasing some properties probably to operate their stores and warehouse. And in one of the leases, they received what was called a tenant inducement payment. Now, we don't know the amount, so I'm just going to make up an amount just so that we can sort of understand how this was done for accounting and tax. They got the payment from the owner of the property that they were leasing from, sort of as an inducement to sign the lease. So let's say the payment that IKEA received was $1 million. And let's say the lease was over 20 years. Once again, these amounts I just made up for illustration purposes only. Now, for accounting purposes, what you would do is you would amortize that payment over the 20 years. And so you would recognize $50,000 a year. So this payment was received by IKEA. IKEA got this tenant inducement payment. For accounting purposes, you don't have to recognize it all as income in the year that you received it. You sort of spread it out over the term of the lease. So you recognize 1/20th or $50,000 each year. IKEA argued that this was not income according to the Income Tax Act. And so I went all the way to the Supreme Court. The Supreme Court concluded that the $1 million was in fact income, but the treatment for tax purposes was that IKEA had to include it all in the year it was received. So not spread out over 20 years. So that was sort of a huge hit to the income tax liability for IKEA, because they then were required to include this full $1 million in income in the year that they received it, and they would have to sort of pay taxes on it. So that's sort of a prime illustration of sort of how accounting rules do not always apply to income tax. And so once again, we're sort of going to see that throughout most of this chapter. One of the next things that is different between tax and accounting is this concept of tax reserves. Tax reserves are basically a deduction. So when you hear the term tax reserve, that's basically a deduction that you're allowed to take this year if you're eligible. So if you're eligible for a tax reserve, you get to deduct it this year. The way that tax reserves work is that if you are eligible to make the deduction this year, you would deduct it this year. That would reduce your business income. Next year, you have to add that reserve back into income. And then you determine, are you eligible for a new reserve in that next year? So once again, we're going to go through an example to sort of put this into perspective. But a tax reserve is basically a deduction. If you're allowed the tax reserve, you deduct it this year. Next year, you have to add it back to income. And then you figure out next year whether you're still eligible for another similar reserve or not. Now, the good thing is there's only 3 reserves that we're going to focus on. The reserve for doubtful and bad debts, the reserve for certain goods and services, also known as the reserve for unearned goods and services, and this inventory reserve for unpaid amounts. The first 2, just going to put a line here. The first 2, we have accounting equivalents. So the reserve for doubtful debts, this is basically, if you sort of look at the wording here, that's basically the same as the bad debts expense and our allowance for uncollectible accounts. So remember from your accounting classes, maybe BFIN 141, BFIN 193, when you have all these accounts receivable, some of them will not pay. So at the end of the year, when you're making your adjusting journal entries, you record a bad debts expense, which is an estimate of how much you think will not be collected. So the reserve for doubtful debts will be the same as the accounting bad debts expense and the allowance for uncollectible accounts. So no difference between the reserve and the accounting treatment. For the next one, the reserve for certain goods and services, also known as the reserve for unearned goods and services, this is going to be the same as unearned revenue or deferred revenue. If you remember, again, from your accounting classes, if you get a deposit from a customer, but you haven't delivered the goods or services yet, you record the cash, debit cash, you credit unearned revenue or deferred revenue, which is a liability. That applies for income tax as well. You end up with sort of the same result. It's just sort of kind of unusual how the Income Tax Act is written, but we'll sort of go through that in the example. But in the end, the deposit that you get from the customer, you don't have to include it in income for tax purposes. It's treated the same as unearned revenue as we do for accounting. This third reserve, the inventory reserve for unpaid amount, this is basically where you may have an installment sale. Maybe you sell an expensive inventory item and the customer pays in installments over a few years. So you sell a really expensive piece of jewelry. It's worth, $500,000. The customer says, well, I'll buy it from you, but you have to let me pay it off in installments, $100,000 a year over 5 years. You agree. For accounting purposes, you would include all of that in income in the year that the sale was made because a transfer of ownership was made to the customer. But for tax purposes, you can take a reserve because you didn't receive all the proceeds on the day the sale was made, as proceeds were going to be paid over a number of years. This one here, there is no accounting equivalent. So for the first two, the reserve for doubtful debts, treat it the same way as the bad debts expense. The reserve for unearned goods and services, treat it the same as unearned revenue. So the first two, the tax treatment, the accounting treatment are the same. But for the third reserve, there's no accounting equivalent. So if you're qualified, you'll get the reserve for tax purposes, but not for accounting. So in order to illustrate these reserves, what we're going to do is we're going to look at assignment problem 6-1. Now, in this question here, we have Amelie. She started a landscaping business in 2024, and we're given information for the first 2 years, 2024 and 2025. And what we want to do is calculate her business income for both of these years. So in this type of question, we're given a bunch of facts, and our goal for each year is to calculate her business income. So let's sort of start with 2024. The first year of business, the business had sales of delivered merchandise and services totaling 185,000. 65,000 of this are the accounts receivable at the end of the year, and she anticipates 5,000 will be doubtful of collections. That's sort of that bad debts expense. So based on that first paragraph, we're going to go over here, look at the 2024 column. And again, what we're trying to do is figure out what is her net business income for first 2024 and then 2025. So that 185,000 of delivered merchandise and services, that would be included in her business income. And then we get the reserve for doubtful debts. The reserve for doubtful debts basically is, once again, the amount that will anticipate to be uncollectible. So she estimated that 5,000 will be uncollectible. So she's going to get a reserve for $5,000. That's the reserve for doubtful debts. And once again, that would be the same as the bad debts expense on her accounting income statement. And then we move to the next paragraph. In addition to the sales of these delivered merchandise, she also received $23,000 in advances for merchandise to be delivered in 2025. This is that unearned revenue that we were talking about. She received a deposit this year, but she's not going to deliver the merchandise until next year. Now, even though the ending result will be the same treatment for tax and accounting, tax rules are written very peculiarly. So I'm just going to sort of draw a line here. The way the tax rules are written, it says that if you get any deposits and advances, you have to add it to income. So even though it was a deposit or an advance, the tax rule says we have to add that $23,000 to income. Then when we get to the end of the year, we determine whether there was any amounts that we received that are still undelivered. So we got the $23,000, we added to income for tax purposes. When we get to the end of the year, we determine, can we take a reserve for any amounts that we haven't yet delivered the merchandise? And yes, this $23,000, we haven't yet delivered the merchandise because that's going to be delivered next year. So we get a reserve. So what you'll notice is that it's still going to be netting out to zero, but just the way the tax rules are written, we include the deposit and income. And then when we get to the end of the year, if we haven't delivered the merchandise, we get to take a reserve. So just a peculiar way, the way the tax rules are written. And then we have the last paragraph. She bought a bunch of landscaping material and she got it at a really good price. She realized that she's probably not going to use it. So now she's going to sell the material for $50,000. The cost of the material is $40,000. So the gross profit is 10. 50 minus 40, 10,000 gross profit. So we know that 10,000 gross profit needs to be included. So we're going to include that 10,000 gross profit here. But let's see how that 50,000 was paid. Because of the size of the sale, she agreed to accept a down payment of 30,000, so 30,000 this year, and then 2 annual installments of 10,000 each. The first installment will be due December 31st, 2025, and then the last installment, December 31st, 2026. So she sold it for 50,000. Minus the 40,000 cost of goods sold. So the gross profit was 10,000. The 50,000, she's going to get 30,000 now. And then on December 31st, 2025, she'll get another. She's going to get another 10,000. And then in December 2026, she'll get the remaining 10,000. This is that third reserve we was talking about. This is the reserve up here that we were talking about, the reserve for unpaid amounts. The customer is going to pay in installments over a few years. So for accounting purposes, you would include the full 10,000 this year. But for tax purposes, this reserve may apply. So I want to talk a little bit about this reserve. This reserve is called the reserve for unpaid amount. And in order for this reserve to apply, there's sort of some criteria. Some of the proceeds is received greater than 2 years from date of sale. So the sale was made in 2024. Some of the proceeds will be received more than 2 years from the date of sale. That is true because the sale was made sometime in 2024. The last payment won't be till the end of 2026. So that's going to be more than 2 years from the date of sale. So that's the first criteria. There's also a second criteria that says that no reserve allowed in year 4. So by year 4, no more reserve can be taken. If the proceeds were spread over 5 years, she could only take a reserve for the first 3 years, and then for the 4th year, there would be no reserve allowed. So those are sort of the criteria that need to be met. Because some of the proceeds are received greater than 2 years from the date of sale, and we're only looking at the 2024 year now, we're not yet in year 4, the second criteria does not apply. So the way that the reserve works is that the reserve or the deduction is going to equal basically the profit times the fraction of the outstanding proceeds at the end of the year divided by the total proceeds. So if we're looking at the 2024 year, we have total profit of 10,000. At the end of the year of 2024, there is 20,000 in outstanding proceeds, and the total proceeds is 50,000. So if you work through that, it's basically saying that because 20,000 of the 50,000 is outstanding, we can take that fraction, 20 divided by 50,000, which is 40%, and multiply that by the 10,000 profit. So she's able to take a reserve of 4,000 in that first year, 2024. Any questions about that calculation? So we go to our column for 2024. We can see here that we include the 10,000 profit. We get to take a reserve of 4,000. So we're only including 6,000 this year. We're only including 6,000 this year. Once again, because 40% of the proceeds are still outstanding. What I'm going to do is down here, I'm going to track the amount we're including for each year. So we're going to take a reserve of 4,000 in the first year. And so once again, the net amount that we're including for the first year will be 6,000. Just what I want to show you how that 10,000 will be brought into income over the 3 years. So the first year, we're only going to bring in 6,000. And then we can just quickly add up the total for this 2024 year. And so the total net business income will be 186,000. Any questions before we move to 2025? So then we move over to our question, and now we look at 2025. In 2025, 5,500 of the accounts receivable were determined to be bad and were written off. All the merchandise for which advances have been received from last year was delivered this year. And the 10,000 installment for the 2024 sale was received. So remember this 10,000? We did get that in 2025. What they're also saying is that this deposit that we got last year, we did deliver all of the merchandise this year that we agreed to. And then they also wrote off 5,500 of accounts receivable. So what I'm going to set up here, let's kind of go up. Let's actually continue reading first. Let's go to the second paragraph. Sales of delivered merchandise total 240,000. Of this amount, 50,000 were sitting in accounts receivable, and she anticipates 3,500 will be doubtful of collection. In addition, in 2025, she also received a deposit or advance of 13,400, and that amount of merchandise won't be delivered until next year. So let's just start off with the 240,000. The 240,000, that's going to be our starting point. That's the sale of delivered merchandise. So that has to be included in income. Let's just sort of focus on the doubtful debts. Remember we said with reserves, if we take a reserve this year, next year we have to add it back. So the 5,000 that we deducted last year, we have to add it back this year. We also get to deduct another reserve this year if we anticipate that some of the accounts receivable will be uncollectible. So what does the question say? For 2025, it says that she expects 3,500 of the accounts receivable to be doubtful of collection. So we're going to put that 3,500 as the current year reserve. But then I also added this line saying that we also get to deduct any actual write-offs. And so if we look at the question, in 2025, she wrote off 5,500 of accounts receivable. So let me just sort of put the 5,500 there, and then we'll sort of explain how this sort of all matches to the accounting amount. If we look at these three amounts here, this results in a deduction of $4,000. I want to just sort of tie this into how this would equal the bad debts expense for accounting purposes. So let me just sort of put column here. I'm just going to set up a T account. So remember, actually, this way. If you remember from your accounting classes, we have our accounts receivable, which has a debit balance. And then we have the contra or companion account called AUA, which would have the opposite, which would be a credit balance. So at the beginning of, at the end of last year, we set up this bad debts of 5,000. So we would have had the 5,000 here at the end of 2024. We know that this year, 2025, we wrote off 5,500 of actual accounts receivable. So when you think about actual write-offs, the journal entry is to debit AUA and then to credit our accounts receivable. So when you do write-off, you're just basically removing them from the accounts receivable listing, and then the debit would go to AUA. So we would have 5,500 here. And so we are now in a debit balance of $500. So what that basically means that last year at the end of 2024, we estimated we would not collect 5,000, but we ended up actually not collecting 5,500. So we underestimated last year's amount by $500, which is fine. Accounting, we have to get comfortable with making these estimates. So we underestimated by $500. At the end of this year, our AUA balance needs to be 3,500 because that's the amount of the accounts receivable we think will be uncollected. Remember from accounting classes, the missing amount is your adjusting journal entry. So to get from a debit balance of 500 to a credit balance of 3,500, you need to make an adjusting journal entry of 4,000, debit bad debts expense, credit AUA, and that's why we get the same result for tax as we do accounting. So as long as we follow these three steps, we add back last year's reserve, we deduct actual write-offs that we made this year, and then we deduct the reserve at the end of the year. The overall effect minus 4,000 will equal the bad debts expense for accounting purposes. Any questions about the reserve for doubtful debts? So once again, some additional steps there, but everything is sort of laid out in the template here as to what you need to do. Then we get to these deposits and advances. So remember we said that if you take a reserve, we have to add it back next year. So that 23,000, we have to add back this year, 2025. And then we ask ourselves, is the 23,000 still undelivered? And the answer is no. Remember it said here in 2025, all the merchandise for which advances had been received was delivered. So that 23,000 advance we got in 2024 we did deliver the merchandise in 2025. So we don't take any more reserves on that 23,000. But then we got another advance of 13,400. And that merchandise won't be delivered until 2026. So once again, the way the accounting, the tax rules work is that 13,400, we add it to income when we get the advance. When we get to the end of the year, is the amount still undelivered? It is. So then we get to take a reserve. The net amount, again, will be 0. But once again, the way the tax rules work, we have to add the advance to income. And then when we get to the end of the year, we determine if it's undelivered, then we can take a reserve. Then the last thing we have to do is with respect to the reserve for the unpaid amount. So this 4,000 reserve we took last year, we have to add it back this year. So we have to add back that 4,000 this year. And then we determine, can we take another reserve for 2025? And so there are still proceeds outstanding. This is not year 4. Remember, in year 4, you can't take a reserve. So we can still take a reserve. The way we calculate the reserve again is we take the gross profit, multiply by the outstanding proceeds at the end of 2025. So remember, at the end of 2025, there's only going to be 10,000 outstanding because we got the 30,000 when we made the sale. We got the 10,000 this year. So at the end of 2025, there's only going to be 10,000. Whoops. It's only going to be 10,000 outstanding. And once again, the total proceeds is 50,000. So essentially, we only get to take a reserve based on 10 over 50, which is basically 20%. And so 20% of 10,000, that's going to be a reserve of 2,000. So if you look at the net impact here, we add back last year's reserve. We take another reserve of 2,000. So we're bringing in a net amount of 2,000 to income. And if I just sort of put the numbers down here under 2025, we add back the 4,000 minus the 2,000 reserve for this year. And so we're bringing in 2,000 into income this year. And then we can just quickly add up the column. And so our business income for 2025 is going to be 261,000. Any questions about 2025? I want to show you what happens with the reserve that we took, the 2,000. So the 2,000 reserve that we took on that landscaping material that was sold in 2024, in the following year, we're going to have to add it back. So when we get to 2026, we're going to have to add it back. And then we can figure out, can we take any more reserve in 2026? And the answer is no, because if you look at the calculation, 10,000 times any proceeds outstanding at the end of 2026. At the end of 2026, everything has been received. So there's no outstanding proceeds. So we cannot take a reserve in 2026. And so therefore, in 2026, we include that 2,000 in income. So if you think about it, the gross profit was a total of 10,000. We included 6,000 in 2024, 2,000 in 2025, and the remaining 2,000 in 2026. And that's how that 10,000 has been spread out over the 3 years. Any questions about this assignment problem? We're going to sort of move on to, again, some differences between accounting and tax. And this sort of talks about deductions. So one of the biggest differences is with meals and entertainment. With accounting, you get to deduct all your client meals and entertainment on your income statement. For tax purposes, you only get to deduct 50%. I think many of you are aware of that. Another difference between tax and accounting is amortization and CCA. Sort of what we did in chapter 5 before the reading break. we cannot deduct accounting amortization for tax purposes, but we get to deduct CCA, and we'll sort of see that later on in today's class as well. Fines and penalties are not deductible for tax purposes. So what they mean by that is, let's say that you were delivering some merchandise to a customer, as part of your business activities. And when you were delivering the merchandise, you got a speeding ticket or a parking ticket. So the speeding ticket, parking ticket, fines and penalties, once again, not deductible for tax purposes. You would make the deduction for accounting purposes, but any sort of fines and penalties are not deductible for tax purposes. If you pay any interest and penalties on unpaid income taxes, so let's say you were late in paying your income taxes and you were charged interest and penalties, you would deduct that for accounting purposes, but not deductible for tax purposes. There's also some differences with automobile CCA as well. Remember last, I guess 2 weeks ago, we talked about the CCA deductible on luxury automobiles, and we said that there was sort of that class 10.1. And we said that, if the car is sort of over a certain amount, you cannot take CCA on that. And let's just sort of bring up the CCA rates table just to remind us of what those amounts were. Bring up the CCA rates table and we look at automobiles at the very top here. You'll see that once again, if we look at automobiles right here, class 10.1, the prescribed amount for 2024 was 37,000. So if you bought an automobile for over 37,000 in 2024, you could only put 37,000 in class 10.1 to take CCA on. Whereas for accounting purposes, you would take amortization on the full value of that automobile. Now, there are some differences with respect to car lease payments as well. And so the textbook does a pretty good job of sort of explaining that. Let me just, also with interest expense on car loans. So I sort of leave that to you to read on your own when it comes to limits on interest expense deductions and leasing deductions for tax purposes. There's a good example on page 359, 360, and also exercise 611. So it's fairly easy to sort of follow. So I'll just sort of let you do those parts on your own, and that will give us sort of more time to talk about other sort of deductions for tax purposes. One of the, actually, let me just sort of make some room here. I wanted to actually talk a little bit about one of these other differences before we get into assignment problem 6-6. On page 343, they talk about limits on property taxes and interest expense on vacant land. So let me just sort of give you an example. Let's say that we have this business and they buy a piece of vacant land for $100,000. That's basically their cost. That's basically known as the adjusted cost base. That's sort of the tax term. And we've talked about ACB before when we had sort of the sale of shares, proceeds minus the adjusted cost base. So a company buys a piece of vacant land for $100,000. Let's say they're planning to maybe build a head office on it at some point in time, but it's basically vacant. In, let's say, 2024, they pay property tax and interest of, let's say, $3,000. The rule says that because the land is vacant, the property tax, because the land is vacant, the property tax and interest is not deductible on vacant land unless there was revenue earned on that vacant land. So let's say the land remained vacant. There was no revenue earned on the vacant land. So that 3,000 is not deductible for tax purposes. But they don't lose the 3,000. The adjusted cost base of the land, remember we said it was bought for $100,000. This 3,000 that is not deductible, it basically gets added to the adjusted cost base of the land. So the land will now have an adjusted cost base of 103,000, which is higher, right? So when if they eventually sell the land, they have a higher cost, so the gain will be lower. So they don't lose that 3,000, they just don't get deducted this year. They add it to the cost of the land. Let's just sort of continue on with this example. Let's say it's now 2025. And so let's say again, they pay property tax and interest on the vacant land of, let's say, 4,000. But let's say that the land is vacant, but there is revenue earned on the vacant land. Let's say this is a piece of property that's vacant, and let's say there was maybe a movie studio that wanted to shoot parts of the movie on this vacant land. And so they rented the land out for maybe a half a day. They paid the company $1,000. And so the revenue earned on the vacant land was $1,000. They could deduct up to $1,000 of the property tax and interest to bring this income down to zero. So they could deduct up to $1,000 of the property tax and interest on the revenue earned on the vacant land. And then the remaining amount, once again, it just happens to be $3,000. The undeducted amount gets added to the adjusted cost base. And so the adjusted cost base of the land now is 106,000. So I wanted to sort of go through that rule with you because it is talked about on page 343, but it doesn't sort of provide sort of the best example in my mind as to how those rules operate. Any questions before we move to the next problem? The problem that I want to do with the class is going to focus on calculating business income, and it's going to include CCA calculations as well. And remember from chapter 5, CCA calculations are really important because they sort of filter throughout the course. We learned about it in chapter 5, but businesses buy capital assets, so they get to deduct CCA. We see it again in chapter 7, rental property. You buy rental property, the building you can take CCA on. And if you end up taking BFIN 451, the corporate tax course, just sort of be revisiting those CCA calculations. So even though this problem focuses on business income, is also going to be a good refresher of what we learned about CCA 2 weeks ago. So let's have a look at this question together. So this is an accountant operating as a sole proprietorship. So his sole proprietorship income will be treated as business income. The owner bought a building in the year 2020. We're in the 2024 year, so he bought the building a few years ago. The 425,000 was attributable to the cost of the building. So he took CCA on the building as added to class 1. And at the beginning of this year, the UCC is 380,000. So if you notice on this side here, I've already set that up. This is the class 1 building that he bought 4 years ago. He's taken CCA on it over the last 4 years. We're at the beginning of 2024, and the balance is 380,000. The thing about class 1 is there's different CCA rates. So I want to just bring up the CCA rates table so we can have a look at what I mean by different rates for CCA as it relates to buildings. So if I scroll down here and I look at just sort of the buildings, oops, trying to highlight this part here. So if you look at the top one, it says buildings acquired before 1988. So if the building was bought before 1988, would go into class 3, would get 5%. That was a long time ago. Anything after 1987 goes into class 1, 4%. But if you notice below that, there's also a 10% and a 6%. And these were sort of new amounts that were added for buildings acquired after March 18th, 2007. And so 2007 was sort of the start of sort of the big financial crisis, sort of Lehman Brothers, a lot of the big financial companies in the US lost a lot of money. So businesses were losing money. And one way that the government here in Canada tries to stimulate investments by having companies buy more assets and invest in sort of assets for their company is to increase the CCA rate. If they increase the CCA rates for buildings from 4% to 10% or 6%, businesses will get a bigger deduction for CCA, and therefore they pay less tax because they have less income. So that's sort of why this data is relevant. So the government said, if your building is used 90% or more for manufacturing or processing, you get a 10% CCA rate, up from 4. If it's for non-residential use, meaning that it's not for housing, it's non-residential, for example, a head office or some sort of office building, then you get 6%. And so that's sort of where this building in our question is for. It's the 6% rate that they'll get because it's for non-residential. It's not for manufacturing and processing, because remember, this individual carries on an accounting business, so they're actually not making anything. But because it is non-residential, it's used as his office, he will get a 6% CCA rate instead of the 4%. So I want to just sort of explain that and bring us back to the Excel document. And so for this class 1, I just want to sort of put the CCA rate here of 6%. So we sort of know where that comes from. And then we move on to the next part of the question. So we dealt with the building that he bought and the balance at the beginning of the year. And then we're told that in February 2024, he replaced all of his old furniture. He bought the old furniture for $65,000 at the beginning of the year. The balance in the CCA class was $41,000. He sold it all for $22,000, and then he bought a bunch of new furniture for $136,000. So furniture and fixtures go into class 8, and class 8 has a 20% CCA rate. So I'm going to just focus on class 8 using the data that was given. So he bought a bunch of furniture probably a few years ago, bought it for $65,000 at the beginning of the year. The balance is $41,000. He sold all of it for $22,000. And then he bought a bunch of new furniture for $136,000. All of this is going to go into class 8. So let's go over to here to class 8 and sort of unpack all that information. So that's the beginning balance of $41,000. Now class 8 has a CCA rate of 20%, and you can check that on your CCA rates table. And then remember, we talked about this concept of net additions. Net additions is all your dispositions minus your new additions. Whenever there's a disposition of an asset that you were taking CCA on, you have to deduct the lesser of two amounts. The first amount is the original cost, which in this case is $65,000, or the proceeds, which in this case is $22,000. So whenever there's a disposition of depreciable assets that you're taking CCA on, in the actual CCA class, you have to deduct the lesser of cost or proceeds. In this example, the lesser would be the proceeds of 22,000. And then we add our new additions. And so the new additions was 136,000. So the net additions, which would be the 22,000 disposition minus plus the new additions, the net additions would be 114,000. So that's the net additions for this class. We add that to the starting amount, and we get a base amount of 155,000. That's what we use to calculate the CCA on. So the CCA that we will be able to deduct will be 155,000 times 20%. And so that's going to be a CCA deduction of 31,000. So once again, a little bit of a review. Once again, it's been a while. It's been 2 weeks since we did chapter 5. But if we sell a depreciable asset that we are taking CCA on, we deduct the lesser of costs or proceeds. Any new additions, we add that as well. The subtotal of that is known as our net additions. And then just to sort of conclude this, then the balance going into next year, January 1st, 2025. The balance going into next year will be 124,000. So I'm just going to highlight the CCA there, so because we know that we will be able to deduct that this year. Any questions about that CCA calculation? Since we're doing CCA calculations, why don't we calculate the CCA for class 1? So there's no additions or dispositions here. So the CCA will just be at 6%. So 22,800. And once again, I'll just highlight that amount so we know that that's a deduction we can take. And then the balance going into next year, January 1st, 2025 UCC, is 357,200. So we've done a couple of CCA calculations. Let's go back to the question and see where we're at now. So we've dealt with the furniture and fixtures, and then he bought a bunch of other property in 2024. A new computer, application software, and client list. So let's sort of find out where these are on our CCA rates table. So computer, application software, and a client list. So let me just bring up the CCA rates table again. And let's go to C for computer. So we go to C for computer. We have computer equipment and system software, class 50, 55%. Computer software application, class 12, 100%. So computer hardware, the computer equipment would go into class 50. System software is basically like an operating system. If your operating system is Windows, then you would add that to class 50 as well. Application software is sort of like Word, Excel, QuickBooks. Those software would go into class 12, and class 12 is 100%. And then we also have the client list. Client list, also see right down here. Client list class 14.1 is 5%. Now, we did this 2 weeks ago. We said that any limited life intangibles go into class 14.1, and there's a 5% CCA rate. So the hardware, the computer will go into class 50. The application software will go into class 12, and the customer list will go into class 14.1. Let's go back to our Excel document. Have a look at those amounts. The computer, 1,800, class 50. Application software, 2,700, class 12. Client list, 32,000, class 14.1. So the computer, we're going to add that, the 1,800. And the CCA rate for class 50 is 55%. And so we don't have a beginning balance, but let's just sort of do a subtotal here. So the beginning plus the new addition, and then the CCA deduction for the year will be just 55%. So that's going to be 990. And then the balance going into next year will be 810. And so once again, let me just highlight the amount of CCA we get to deduct, 990, so we can keep track of that. I'm going to do the customer list next. And so the customer list, the new addition was 32,000. And once again, there's no beginning balance, but we'll just do a subtotal anyway. And the CCA deduction. And the CCA rate for class 14.1 is 5%. So 5% of 32,000 is 1,600. And then the UCC going into next year, 30,400. And once again, highlight the CCA that we get to deduct. So those two are fairly straightforward. I want to talk a little bit about the application software in class 12. Class 12 has a 100% CCA rate. Basically, you get to deduct the full amount this year. The new addition that we had this year was 2,700. But there's a bit of a wrinkle here, and I make reference to this page 280, paragraph 5-84. This is from chapter 5, and I basically have it down here. Class 12. So let's just have a read through this, what this says. So for class 12, qualifies as 100% write-off. However, some items included in class 12 are subject to the half-year rule, resulting in only 50% of CCA that can be claimed. These items that have this half-year rule are computer software and certified Canadian films. So what that means is that this computer application software that goes into class 12, even though class 12 is 100% write-off in the year that you purchase the asset, because of this rule, it's subject to the half-year rule. That means they can only take 50% this year, and then they take 50% next year. So just wanted to sort of show you that. So even though we have this new addition, we have this half-year rule, and so we can only deduct 50%. So 50%, we can only deduct 1,350. So then the balance going into next year will be the remaining 50%, 1,350. So I just wanted to sort of show you that because there are, these sort of unique situations where there's sort of an exception from the general rule. Any questions about this class 12 calculation? Let's continue on with the next paragraph. Because he started providing in-home services for many of his clients, he decided to buy an automobile on January 1st, 2024 for $56,000. This is not a zeros emission vehicle. He drives it a total of 23,000 kilometers, of which 21,000 relate to business. His operating expenses for the year for the car are $4,140. So this is an example of what we talked about earlier, where for accounting purposes, he would take amortization on the full 56,000. But remember we said that when you buy a car over a certain amount, then you get limited as to how much you put into the CCA class for CCA purposes. And for 2024, that amount again was 37,000. So remember when we looked at that CCA rates table a while back and I showed you the automobiles, I'll bring it up again. For 2024, the threshold under automobiles here, the prescribed amount for 2024 is 37,000. So that means that only 37,000 can be added into class 10.1, not the full 56,000. So let's go back to our Excel document. Again, the car was 56,000, but for class 10.1, we can only add up to 37,000. And class 10.1 is 30% CCA rate. So then the CCA will be 11,100. Let me just put that as a minus sign. And then the balance going into next year, $25,900. Now, because he didn't drive the car entirely for business, this CCA deduction needs to be prorated. If you remember in the question, he drove the car a total of 23,000 kilometers, but only 21 were for business. So we add the full 37,000 to the class 10.1, and then we figure out the CCA based on the full amount. And then what we do is we will prorate this by 21,000 over 23,000. And so we take the maximum CCA, 11,100, multiply it by 21,000 over 23,000. And so the actual deduction is going to be 10,135. And the thing is, this ratio, 21,000 over 23,000, that's going to change every year. So next year, let me just sort of show you what will happen next year. Next year, we would still calculate the CCA deduction at 30%. So we would get 7,700, but then we would prorate that based on the kilometers for next year, because that would be different, right? Maybe next year he drives at a total of 15,000 kilometer and 10,000 is for business, then it would be 10 over 15. So we put the full amount into the CCA class, and then every year we would calculate the maximum CCA, and then we prorate it based on the business kilometers over the total kilometers. Any questions about that? So we've done all the CCA calculations, but we haven't actually looked at the income and other expenses for his business. So we know that there's car operating expenses, 4,140. He has all these other business expenses, and then we're given his revenue for the year. So why don't we go back to the top of this question? We'll put down the revenue, 224,000, and then we'll list all these expenses as well. The only adjustment that we'll have to make is to the meals. Remember we said that for the meals, only 50% are deductible. So that will be the only adjustment we have to make. And then we'll also have to make an adjustment for the car operating expenses. Once again, using the 21,000 kilometers for business over the 23,000 kilometers total. So let's go back up here. We'll put down the total revenue, which is the 224,000. we'll list the deductible expenses. He had the operating expenses. So that was 18,600. The amount paid to the assistants, that was 31,200. The office expenses, that was 9,400. And then 50% of the meals. And so 50% will be 5,250. Now, the total CCA deductions, that's basically going to be all the amounts in the yellow. So let's just sort of add all the amounts in the yellow. Now, the class 10.1, the 10,135, I'm going to have to sort of add that separately because it is not in its own cell. So I'm going to just put those amounts. And then I'm going to add the CCA for class 10.1, the 10,135. Well, and that would be the total CCA. So all the yellow amounts, the CCA deductions, 67,875. And then the last amount was the car operating. And so remember we were told that the total amount was 4,140. Once again, we have to multiply that because that was for the entire use of the car, including personal. So we've got to multiply that by the business kilometers, 23,000 over total kilometers. Oh, sorry, business kilometers, 21,000 divided by total kilometers, 23,000. And if we work through that calculation, the car operating expenses will be 3,780. Let me just double check that. Yeah, 3,780. And so all we are doing then to calculate the net business income is just going to add up this column here, starting with the revenue minus all these expenses. And so the net business income is going to be 87,895. So what you can sort of see from this calculation, this particular problem, is that most of these expenses, the operating, the assistance, the office expenses, most of those will generally be treated the same for accounting and for tax. Some of the differences are the meals and entertainment, only 50%. Amortization is not allowed, so we had a bunch of CCA deductions that we had to calculate. And then also for the car operating, we had to prorate it based on, once again, business kilometers over total kilometers driven. Any questions about this assignment problem? Are we for time at 7:14? Let's see. Why don't we take a break? So we'll take a short break and well, let's come back at 7:25 then, about 10 minutes. We have sort of a couple main topics to still cover. We still have to talk about home office expenses, which is what we will be doing after the break. And then the last big topic that we're sort of going to do is to do with this sort of schedule reconciliation here as well. So we'll take a 10-minute break and then I'll see you back here at 7:25. What we're going to do next then is look at home office expenses, also known as workspace in-home expenses. So if you're operating a business, let's say a sole proprietorship, and you're using part of your home as a home office, then some of those expenses are deductible provided you meet one of these two conditions. The workspace that you're using is the principal place of the business. So if you're operating as a sole proprietorship and you don't have a separate office and you're using your home office as the principal place of operating the business, then that criteria would be met. Or another way of meeting this condition is the workspace that you're using in your house is used exclusively for earning business income, and you're using it on a regular and continuous basis for meeting clients and customers. So if you have a home office and it's only used as your home office, you're not using it as a dining room table, you're not using it as a TV room, it's used exclusively as your home office, and you're using it to earn business income and you meet clients regularly, could be even virtual client meetings, then that would also qualify for you to deduct home office expenses as well. So remember, this is an or statement, and as long as you meet one, then you would qualify to deduct home office expenses. Now on figure 6-2, they show us which home office expenses are deductible. And so what I did was I have figure 6-2 here. Now they show us the expenses that are deductible for employees that do not have commission income, employees that do have commission income. And then what we're going to focus on today is if you operate a sole proprietorship and you have business income. So what you'll notice is that what we talked about earlier, you get a lot more deductions for business income than you do for employment income. So you get to deduct a portion of your rent if you're a tenant, utilities, repairs and maintenance, telephone, internet. If you own the property, you pay property tax, you can deduct a portion of that as well. If you pay home insurance, if you own the house, you can deduct a portion of your mortgage interest, and also you can take CCA on the house as well. A lot of people, even though they can take CCA on the portion of the house as a deduction from their business income, a lot of individuals don't, partly because it could sort of taint the principal resident designation. What we'll learn in chapter 8 is that if you own a principal resident and you sell that principal resident later on, the gain is not taxable. It could sort of be tainted if you use the house, a large portion of the house, let's say for business, and you take CCA on the house. It could also be tainted if you, let's say, rent out a large portion of the house and you take CCA to deduct against your rental income. So even though you can take CCA on the house as a deduction if you're operating a home office for your sole proprietorship, a lot of individuals don't do that because they don't want to sort of taint any sort of principal resident designation. So if they do sell the house later on at a huge gain, if it's 100% principal resident, then they don't have to pay any tax on that gain. But this is just a summary of all the home office expenses that one could deduct against business income. Now, a couple other rules. Home office expenses cannot be used to create or increase a business loss. So if you already are losing money in the business and you already have a business loss, you cannot deduct home office expenses to make the loss bigger. Anything that you cannot use this year can be carried forward indefinitely and deducted against income from that same business in later years. And so in the example we're going to do today, we're going to sort of look at these home office expenses. We're going to calculate the income before the home office expenses and then determine, are we able to deduct all or some of the home office expenses? So we're going to look at assignment problem 6-8. And in this example, we have a music instructor and he's an employee, but this year he started teaching music on his own. So this is his sole proprietorship. On April the 1st, 2024, he decided to start teaching music to a number of children in his neighborhood. And so this is going to be his business income. He wants to know which expenses are deductible. And so he's also given us some more information about a portion of his home that he's using to operate his business. He's not using the den in his office. And so that's where he's going to be doing his music lessons. And the total square footage of the house is 2,000 square feet. And the percentage of the home which is being used for his business is 10%. So 10% of 2,000 would be 200 square feet. So I kind of just put that down here. We know that 10% is the portion of his home office expenses that we have to prorate. So we add up all the home expenses, then we prorate it by 10% to figure out how much he's able to deduct for his home office expenses. Another thing to note is that he started his business on April the 1st. So he has a short fiscal year. And this is going to be applicable when we look at his CCA calculations. And this is something we did cover 2 weeks ago in chapter 5. If you have a short fiscal year, that usually will be the first year of business or the last year of business where you're not operating for the full 12 months, then you have to prorate your CCA based on the number of days in that fiscal year. So his business started on April the 1st. He's going to have 275 days in this first short fiscal year. If we look at the next part of the question, we're told that during this first year, he earned 5,700 in music fees. So that's his revenue. So let's look at this statement here. And let's put down his revenue of 5,700. And then we'll look at the expenses that he's allowed to deduct. So he's given us a list of all his expenses, and he wants to sort of know whether he can deduct these or not. So let's just sort of go through these one by one. Music books, $250. Now, there's sort of a note here saying that assume the music books will have to be replaced every year. So what they're saying is that this should be just treated as a current expense. Is not going to be a capital asset, is not an asset that's going to last a number of years that he has to take CCA on. So we're just going to deduct the music book expense as a current expense, all 250. So that will be fully deductible. The supplies, now generally speaking, he has to use the supplies in order to deduct them, but we're not sort of giving any additional information. So we'll just assume that all the supplies that he bought, he used during the year. So that is a deduction as well, the full $1,000. And then there's this tuxedo that he bought to wear at students' performances. Now, clothing is not deductible unless it's sort of specialized clothing, like a special sort of uniform or protective gear. If they were operating, let's say, some sort of business where he needed protective gear, then it would be deductible. But just sort of general clothing expenses are not deductible. So that 350 would not be deductible. So let's just sort of start putting down the expenses that he can deduct, the 250 and then the $1,000. So let's put down the 250 first, and then the $1,000. And then let's move on to the next one. The next one is the snacks. So the snacks for students total 250. So if you think about the snacks, the students are his clients. So basically, this is just meals and entertainment for his clients. And so we said with meals and entertainment, only 50% are deductible. So let's take 50% of the 250 and we'll put that down here. So I'll just make a note here. So meals at 50%. So that's going to be 125. continuing on with the expenses, now we have a bunch of home office expenses, the utilities, the mortgage interest, and the repairs and maintenance. So we're going to put that separately because remember, we still have to prorate it by the 10%, and then we can only deduct it as long as you don't create or increase a loss. So let's put down the utilities, the mortgage interest, and the repairs and maintenance under our home office expenses. So we have the utilities, 3,500, the mortgage interest, 11,000, the repairs and maintenance, 2,600. So the total is going to be 17,100. But then once again, we have to prorate it. So we're going to multiply it by the 10%. Because remember, only 10% of the house is being used for his business, his home office. And so that would be his maximum home office expenses, 1,710. But once again, let's just sort of leave that here because we cannot create or increase business loss with home office expenses. So we'll just sort of leave this here for now until we figure out what that subtotal is of the business income and figure out whether we can deduct all of it or not. And then we're also told that the last two items was software for a music program and then an electric piano and bench. So let's see what we need to do with the software and the electric piano and bench. So this software program is application software. And remember in the example we did before the break, we said that application software goes into class 12. And even though class 12 is 100%, application software falls under the half-year rule. And then we have electric piano and bench. So let me just bring up the CCA rates table and see if we have anything under piano. So we look under P, there's nothing for piano under P. There's nothing under M for musical instrument. So what we're going to do then is we're just going to put everything just sort of under, sort of equipment. Equipment not specifically listed anywhere else is going to be at 20% class 8. So the very last one here, equipment not specifically listed anywhere else. So if you have any sort of equipment that is not specified, then the safe bet is to put it in class 8 at a CCA rate of 20%. So that's where we're going to put the piano and bench in. So for these CCA calculations, let me just bring us back to the Excel spreadsheet. I'm not going to do sort of full continuity calculations for the application software. So for the software, let's just do the calculation up here. We know it's going to go into class 12, which has 100%. But because it's application software, we know that the half-year rule applies. So the amount of the software was $300. The half-year rule applies. So we have 150. But remember we talked about that short fiscal year? We said that because this is the first year and it's a short fiscal year, we have to prorate the CCA by the number of days in the fiscal year, which is 275 over 365. So that 150, we have to multiply that by 275 over 365. And so the CCA that's going to give us is going to be about $113. So round it to the nearest dollar, $113. Once again, I'm just going to highlight that so we don't forget it. And then the piano and bench, once again, that's going to go into class 8. That's 20%. And once again, let's just do the calculation. We know that the price was 5,000. We multiply that by 20%. That's going to give us $1,000 evenly. And then we have to multiply that by 275 over 365. And so 1,000 times 275 divided by 365. It's going to give us, rounded again, is going to be 753. And so that would be the CCA on the piano and bench, which goes into class 8. And so we just bring those amounts up here, the total CCA, the 113, and the 753. Then the total CCA is going to be 866. Any questions about the CCA calculations? And then what we need to do then is, once again, do a quick subtotal. So we need to figure out what is the income or loss before home office expenses. And that's going to be 3,559. So this is the income before home office. And so we can only deduct home office expenses. To bring the income down to 0, we can't create a loss, but the home office expenses are only 1,710. Right down here, 1,710. So what that means is we can deduct all of it. And our net business income will be 1,749. So once again, if we were this individual and they were operating this sole proprietorship, this 1,749 would go into 3A when calculating net income for tax purposes. So that sort of brings us all the way back to the first class we had, 3A plus 3B minus 3C minus 3D. So this individual has employment income. They're a music teacher at public school, but they also have a sole proprietorship. So their sole proprietorship business income will be 1,749, and they just add that when they calculate their net income for tax purposes. Any questions about this assignment problem? So what I want to sort of look at next then is this chart here. Actually, let's just sort of finish up this question. I don't think we finished it in total. Let's go back to this question first. So we did A, we talked about which expenses are deductible. We calculated his minimum business income for the year. And then C, briefly describe any issues that should be discussed with Billy concerning the workspace and home expenses and other business expenses and costs. So this sort of ties to sort of why people hire an accountant, a tax accountant, is that to sort of see if there are any other amounts that can be deducted. We know that for his home office, he gave us information with respect to his utilities, mortgage interest, and repairs and maintenance. If we go back up to this list here, we know that he's not renting because he pays mortgage interest. So he must own his home. We have the amount for utilities and repairs and maintenance. What we don't have is any information with respect to these amounts here. Does he have maybe a phone that he uses to contact his students? Internet costs? Some of that could be deductible as well if he uses the internet to sort of schedule appointments with his students. Because he does pay mortgage interest, he must pay property tax. So if we ask him for his property tax bill, then he could deduct 10% of that. And then also home insurance. He likely probably did buy home insurance as well. And so these are things that as a tax accountant, we would sort of let our clients know that these amounts are deductible. if they applied, asked the client for those amounts, and therefore that would just be additional deductions that will bring their income lower. So that's sort of the last part of this question. The last sort of main topic that I want to focus on is this reconciliation schedule, figure 6-3. Now, this is how we get from accounting income to net income for tax. You're going to sort of see this if you end up taking the corporate tax course, BFIN 451, you're going to see this similar table in the first chapter in the BFIN 451 class. This is what corporations do. Corporations prepare their financial statements. So when they go and file their tax return, they will already have their accounting income. They'll start with their accounting income. They'll add back items in this column that are applicable. They're going to add back their accounting amortization because that's not deductible for tax purposes. But what they will deduct instead is CCA, capital cost allowance. So this is sort of a summary of items. If you're starting with your accounting income as the starting point, how to get from your accounting income to your income amount for tax purposes. And once again, this is very, very common for corporations because they will have already prepared their financial statements. So they'll start with their accounting net income, go through these adjustments to get to their income for tax purposes. But what we're going to do is we're going to work through this example here. We have this company, and they're a manufacturer of hardwood floors. They have a December 31st year end, and for the year end at December 31st, 2024, they've already determined their accounting income before taxes to be $126,300. So they've already prepared their financial statements. And so what we're going to do is we're going to start with that accounting net income. We're going to go through a bunch of reconciling items, additions and deductions, and then that's going to give us their net income for tax purposes. And so once again, a very common exercise that corporations have to do because corporations will already have their accounting net income based on their income statement, and then they'll do these reconciling items to get to their income for tax purposes. So this will sort of be a good sort of way to sort of look at, again, differences between accounting and tax. So the first one, let's look at the first item here. Item number 1, they deducted accounting amortization of $24,000. So in their accounting financial statements, they deducted accounting amortization of $24,000. And we know that the CCA that they're allowed to deduct this year is $28,000. So those calculations have been done for us. And so once again, if you look at figure 6-3, we have to add back accounting amortization, but then we get to deduct CCA. So on the schedule here, we're going to add back the accounting amortization of $24,000. And then under the deductions, we'll get to deduct CCA of $28,000. Now, once again, in this question, they've already calculated the CCA for us, but of course, the accountant would have had to have figured that $28,000 amount out. So that's the first one. That's fairly easy. And then we get to item number 2. The accounting expenses included $4,800 in business meals and entertainment. And so we know that only 50% are deductible. So they deducted 100% to get to $126,300. And so according to figure 6-3, we have to add back 50% of the meals and entertainment. So the full 100% was deducted. So all we need to do then is add back 50% of the meals and entertainment. So that's going to be 50% times 4,800, So we have to add back 2,400. They also deducted in their accounting income statement a $2,000 expense for a late filing penalty charged by the CRA. So remember we talked about this earlier. We said that any interest and penalties paid to the CRA, deductible for accounting, but not deductible for tax. So because we did deduct this 2,000 when we calculated the 126.3, if we go over here, we'll see that we do have to add back any interest and penalties on income tax assessments. So that 2,000 CRA penalty, we have to add back. Item number 3, recapture of CCA and a terminal loss of 800. So recapture and terminal losses, those are terms that we learned in chapter 5 2 weeks ago. Recapture, remember we said recapture, we took too much CCA, so we have to add that back into income. Terminal loss, we have a positive amount in the CCA class, but there's no assets remaining at the end of the year. We get to deduct that amount from our income. So these are items that are exclusive to tax. The recapture and terminal loss would not have been in the accounting net income. So we look at figure 6-3. What it shows us is that any recapture, we add it back, we add it, because recapture means additional income, and then any terminal losses, we get to deduct. So let's add the recapture and deduct the terminal loss because those do not have accounting equivalents. But the recapture is additional income that we have to include for tax purposes. That is going to be $300. And then the terminal loss we get to deduct is going to be for 800. Then we get to item number 4. Item number 4 says this year, 2024, we get to take a tax reserve on unpaid amounts of 7,000. Remember the tax reserve for unpaid amount? That was that one we looked at the beginning of the class, that installment sale. We got paid over a number of years. And so they correctly calculated that we do get to take a tax reserve this year for 7,000. Relating to the same unpaid amount, last year we deducted a reserve for unpaid amount of 6,000. So remember how reserves work? Any reserve that we deduct in one year, we have to add back in the next year. So this 2023 reserve that we deducted last year for 6,000, we have to add that back this year. So the 2023 reserve that we deducted last year, we add back this year, 6,000. And then we determined that we were still entitled to a new reserve in 2024. And that amount was 7,000. So it's sort of tying in what we learned about any reserves that you deduct one year has to be added back in the following year. And then in that following year, you then determine, can you take another reserve? And in this case, we did for 7,000. Accounting income includes a loss of 18,000 on the sale of capital assets. So this one relates to capital losses. Remember we said that for 3B, that's the excess of the taxable capital gains over the allowable capital losses. And we said that 3B cannot be negative. Any sort of unused amount in 3B will be what we call a net capital loss carryover. So what we're told is that when they calculated their accounting net income, they deducted this capital loss of 18,000 to get to 126,300. Now we know that only 50% of that is deductible for tax purposes, but we also know that 3B cannot be negative. So what do we have to do in this situation? So we have an accounting loss. Any sort of accounting losses, we have to add back. Because remember, the accounting loss is the full 100% amount. So we have to add that full amount back. Now, if we had an accounting gain, we would have to remove all of that accounting gain because once again, only 50% would be taxable. So any accounting losses, accounting gains have to be sort of removed. So we have an accounting loss. In order to remove it, we have to add it back. If we have an accounting gain that was included in net income for accounting purposes, we have to remove it by deducting it. So let's remove the gain, the loss, by adding it back. So we deducted the loss to get to 126.3. So now in order to remove it, that accounting loss, we're going to put an addition of 18,000, and that will basically eliminate it now, right? We deducted it earlier. Now we're going to add it, so that's going to net out to 0. And then we got to figure out, do we have anything in 3B? Well, 3B, we don't, because for 3B this year, all we would have is the allowable capital loss, which is equal to 18,000 times 50%. And so that would be 9,000. And because 3B cannot be negative, 3B will end up being 0. This 3B amount is right here. If we have excess of taxable capital gains over allowable capital losses, we would have to add that amount when we do this reconciliation. But because in our example, 3B is equal to 0, we don't have to make any adjustments because we don't have any taxable capital gains. All we have is an allowable capital loss. And because this amount is unused, what that means is we're going to have a net capital loss carryover of $9,000. So 3B can't be negative. We don't have any taxable capital gains. So this allowable capital loss cannot be used this year. And so it becomes a net capital loss carryover. Since 3B is 0, that means we don't have to add anything in our reconciliation schedule. Any questions about that? And then we get to our last one, which deals with warranty. If you remember from your accounting classes, if your business provides a warranty on the products it sells, at the end of the year, they have to estimate the warranty expense because the customers are not going to come in for the warranty claims, probably not until next year or maybe the year after. And so the warranty expense on the accounting income statement is just an estimate. Now, during the year, the actual warranty expenditures that the company paid out was $2,900. On the income statement, they deducted $3,500, but the actual warranty expenditures was $2,900. So what are the tax rules with respect to warranties? The tax rule says you can only deduct the actual warranty expenditures. You cannot deduct the estimate. So what does that mean? If we go back to this schedule here, what that means is we have to add back the accounting amount. We add back the warranty expense that was on the income statement, but we get to deduct instead the actual warranty expenditures. So in this example, we would add back the warranty expense. That was just the estimate. And that amount was $3,500. But then we get to deduct the actual warranty expenditures. And that amount was $2,900. And that would be our reconciliation. And so what we would do then is just total up this column here, starting with our accounting net income. And so we would get net income for tax purposes of 143,800. And then we would also have this net capital loss carryover of 9,000 that we could use in other years. I'm going to sort of also do another example with gains and losses, but for this first example, are there any questions? I want to focus just on the capital gains and capital losses in this example, because all we had was a capital loss. Only 50% of that was allowable. Because there was no capital gains, 3B was 0. I don't see any questions coming up. So what I want to do then is just sort of do another example, just to sort of illustrate where there could be an amount for 3B. So let's just sort of do a really simple example down here. Let's say that we have accounting net income. And let's say the accounting net income is $100,000. So let's just sort of break it down as to what that's comprised of. So let's say this accounting net income is comprised of our business operating net income. So the business operating net income, let's say, is 85,000. And then let's say also on the income statement, we have this gain on sale of capital asset. And let's say the gain was 20,000. And then let's say there was also a loss on sale of capital asset. And this loss was 5,000. Oops. And so that's how we get 100,000. So let me just do that. Make sure that's 100,000. Yeah, that's 100,000. So based on our financial statements, our accounting net income is 100,000. Let's say for this business operating income here, let's assume there are no accounting and tax differences. So let's just say that the accounting amortization that they deducted happened to be the same as the total CCA that was allowed to be deducted. So let's just, for simplicity's sake, let's assume that there was no differences in the 85,000 for accounting and tax. So the 85,000 is fully acceptable for tax purposes as well. So we don't have to make any adjustments with respect to the 85,000, but we need to sort of think about the accounting gain and accounting loss. So remember we said in figure 6-3, any accounting losses we have to add back. So any accounting losses, we have to add those back. Any accounting gains, we have to deduct them. So let's do that first. So in this simple example, so the accounting loss, we're going to remove it by adding back 5,000. And the accounting gain, we're going to remove it by deducting it. So you can sort of see here that the loss will now be eliminated. The gain will now be eliminated. So that's sort of the first step. But now we got to figure out, what is the 3B amount? The excess of the taxable capital gains over the allowable capital loss. So remember, if we look at figure 6-3, that's this one here. So we added back the accounting loss, we deducted the accounting gain, and now we got to figure out the 3B amount, the excess of the taxable capital gains over the allowable capital loss. So to figure that out then, the calculation would be the taxable capital gain would be 20,000 times 50%. So that's going to be 10,000. And the allowable capital loss is the loss of 5,000 times 50%. And so that's going to be 2,500. So the excess of the taxable capital gains, 10,000, over the allowable capital loss, 2,500. So that excess is going to be 7,500. So then we will do a quick total for this column here. Not the full column, just starting with the accounting net income. And so the net income for tax is going to be 92,500. And if you think about what this is comprised of, this is comprised of 85,000, which is the net business income. So that would be included in 3A for this individual. This is a sole proprietorship. So remember this 85,000, we assume that there was no differences between tax and accounting. So that would be the 85,000. And then in 3B, that would be the 7,500. This would be the excess of the taxable capital gains over the allowable capital loss. And that would be in 3B on their tax return. But once again, the total would be 92,500. So I kind of want to just show that part to you because it does get a little bit confusing when it comes to gains and losses. You remove the accounting amount, so you add back the accounting loss, you deduct the accounting gain, and then you figure out if there's a 3B amount. If there is, you include it. If 3B is negative, then you can't have a negative amount, so that becomes a net capital loss carryover. Any questions about this simple example here? I'm just going to bring up eLearn quickly just to sort of review what's coming up. So as I mentioned at the start of today's lesson, the next midterm is in 2 weeks' time. So we see here that the chapter 6 homework is going to be due on Sunday. So now that we've gone through chapter 6, make sure that you get that done. The midterm, next week we're going to go through chapter 7, and then the midterm will be in 2 weeks' time, Wednesday, March the 12th. I'm going to work on the midterm this week. So before next class, I'll have details with respect to the midterm as to how many multiple choice questions, how many problems. It will be chapters 5, 6, and 7. So that would be the coverage of the midterm. Are there any questions at all? Any questions that I can answer before we wrap up for today? Let me just quickly check the chat. Don't see any questions there. So make sure you get your chapter 6 homework done by Sunday. Next week, we're going to go through chapter 7. And then the week after that will be midterm number 2. And I'll get the details up within the next week. And so I can answer any questions next week about midterm number 2. But the coverage again will be chapters 5, 6, and 7. Don't see any questions. So it's almost about 8:15. That is it for tonight. Hope everyone has a good night. And we will see you next Wednesday at 6 o'clock. Okay, everyone, have a good night. Take care for now.
Thank you.
Good night.